We're going to move to our Alpha Strategies panel. Really happy to have Tyson Aly with us. Mark Powell's going to be moderating. Manoj Ramnani is going to be coming right up here right now as soon as we get some seats. Annabelle, can we help with the seats here? Great. And I've got Suzanne Murphy, who's one of our great hosts of our podcast, who's going to be speaking as well. She's just fantastic. So why don't we get started? Mark. Oh, there you are. Perfect. We're gonna get you chairs. That's our strategy.
I've got it.
Set up now. Unless you guys want to sit at the couch.
No, it's too loud.
I need to.
There's just two of us here. Oh, it's just two? Yeah. So we should be a little closer.
Chip took a front seat. I tell you.
I want to see what you're doing.
Yeah, nothing good. You already know that, though. All right, just waiting for one more, right?
Yeah.
Oh, he's up there. Tyson's online, right? He was talking during the last session. Tyson, there you are. I can see you now. I felt like Jeffrey set you up perfectly with that talk.
Yeah, thank you, Jeff.
Well, welcome everybody, and welcome to this discussion on Alpha Strategies. Marty, you put together another tremendous panel, so thank you for that. I'm very excited to lead this discussion. Alpha Strategies, our investment approach is designed to outperform the benchmarks like the S&P 500 or the market's average performance, however you measure that, adjusting for risk. The aim is to deliver excess returns through skillful selection, timing, or market insights by exploiting inefficiencies, undervalued opportunities, or specific trends across stocks, bonds, and alternatives. Marty has launched a new podcast, by the way. If you haven't tuned in, Marty, where can I hear that?
We are Resilient Alpha, and it's all over YouTube. It's on LinkedIn, and we're on 5 other social media.
You have a great segment with Suzanne.
We have a landing page.
We have a landing. We have
called resilient-alpha.com.
Yeah.
Thanks.
So the episodes are all cataloged there.
We'll catalog all the episodes on Spotify too.
Beautiful. And they can all go there and they can listen to them and watch them.
Absolutely, and I highly recommend that they watch Chip Perkins' episode. He's sitting right next to me here.
Chip is always worth listening to.
Yes, absolutely.
So you should probably do it twice because you'll miss most of it the first time and catch all the wisdom he dishes out the second time. Anyway, we have a great panel this afternoon to discuss Alpha Strategies. We have Suzanne sitting right here, Suzanne Murphy, Managing Director of Lampen Conway. Special situations and distressed investments represent outside returns if you know what you're doing. And Suzanne will talk to that point. Sitting next to her, we have Manoj Ramnani. I'm sorry, I totally mispronounced that. You want to hear Ramnani? There you go. It's simple enough, but you know, me being me. Founder and Chief Investment Officer for 93 East Capital, a trading strategy that seeks to monetize macro views by implementing thematic strategies. So he's going to talk about what themes he's really hot on this morning and what things he's looking forward to. So looking for that. And then we have Tyson Aly, who's already been set up with his talk by Jeffrey Hughes, who always does a great job. So Tyson talks about the great rotation, and he's particularly bullish on gold, as you heard Jeffrey Hughes speak to gold and what it offers. And he's got some interesting thoughts on where within gold you can find extra alpha. So we'll be looking forward to having Tyson to explain all that. My name is Mark Kyle. I've been involved in alternatives since the mid-90s, marketing, capital raising, fund administration services, things along those lines to help people to get into alternatives and make alternative investments. I'm currently a managing director at Pwick Capital Partners. We're an investment banking firm, so we do a lot of mergers and acquisitions, capital raising for funds and also for companies. Usually companies in the lower middle market is where we operate a lot. We're particularly active right now in the defense sector, so we're seeing a lot of deals and doing a lot in that area. Several of our people are veterans, so that's a great way to tap into that market. Chip, it's your favorite part. It's the disclosure. Chip always gives me a hard time about doing the disclosure, but this panel is for educational purposes, not to be considered tax, legal, or financial advice. To the extent that one of us offers an opinion, it's our opinion alone and not necessarily those of our employers. So there you go. For the next hour, we're going to have a great conversation. Let's get it going. And Suzanne, if you introduce yourself first, I'd appreciate that.
Sure. For those of you who don't know me, I see a lot of familiar faces. I'm Suzanne Murphy. I'm a managing director of Lampen Conway. My partners ran a very successful fund in the value with a catalyst special sits lower middle market distress space until about a decade ago when they became a family office themselves. We are in the process of reinventing that product because we think the timing couldn't be better for the kinds of things we look at, particularly in the lower middle market. I've been in the alternative space longer than I care to imagine. I was on the sell side for many, many years before that. And I also have my own family office, SEM Investments, and I am a co-host on the Resilient Alpha podcast and have interviewed everyone from one of the biggest launches of the year, Derby Lane, Adam Pekarsky, who after 17 years at MSD started a real estate lending fund, to Alan Patrikoff, who many of you may know, who's ground zero for venture capital probably in this country, second investor in Apple, among many other things, Jeff Asaph from ICG Advisors, and more. So it has been a great platform that Marty's put together. We've had some great speakers and panelists, and please go watch what we talk about. Oh, Kevin McGovern yesterday. That's like a sneak peek.
That's a teaser for the upcoming year. When's that going to be released?
Probably within 3 weeks.
Within 3 weeks. All
But
right.
we've got a bunch coming out this month that aren't out. I think ICG is not out. Kevin Ryan.
So
Yes, it was a very interesting conversation. For those of you who don't know, Kevin McGovern has, I think it's McGovern Capital, McGovern Industries. He was a deal lawyer that became sort of an innovator in the product space with patents and helping businesses grow around the world. He was one of the founders of Sobe, which was a beverage company that grew phenomenally. In 3 years, they sold it to Pepsi. He's got a plastics company that makes plastic. This was fascinating, actually. Makes plastic out of sugarcane waste. So when you go to Subway and the guy's making your sandwiches wearing one of these gloves, when they're done, you can put it in the dishwasher and the heated water causes the sugarcane waste to melt and just go away. So he's doing pretty interesting stuff. We talked about a lot of it.
It's a big client, yeah, studying alternative plastic technology. That's the demonstration it does where the gloves actually melt in a hot glass of water after use. It's pretty interesting.
We should have done that on the taping yesterday. He did pull out a glove. We weren't prepared for that, but he does say that the
wash dishes, huh?
well, but he said that the plastic is actually, or his plastic, whatever it's called, is 3 times stronger than regular plastic. And when I did put on the glove, it did feel stronger than like the regular flimsy plastic glove you get. So
Big, I mentioned earlier, the plastic wrap, bubble wrap. It's they didn't make any revenue last year. There'll be probably 25-50 million this year.
Wow.
Doing
Nice.
really well. It's exciting technology.
Fantastic. Manoj,
for sure, he was a lot of fun to talk to, but like a really good human as well.
we're going to have Manoj introduce himself.
Hi, I'm Manoj Ramnani. I am the founder of 93's Capital. I spent most of my career on the buy side, about 20 years, mostly at JP Morgan in a group called the Chief Investment Office, where we basically manage the bank's balance sheet, about 300 billion in assets, and had investments across the fixed income space, credit, some private equity. Spent a year at a hedge fund again, a macro fund, and 3 years at an insurance company helping manage their investment portfolios, about 10 billion in assets. I started 93's Capital about 4 years back, just sort of having seen a number of things work and not work over the course of my career. Still an emerging manager. It's a global macro fund. We price liquidity, and we run sort of thematic strategies based on my strong views on the U.S. economy, the Fed, and interest rates.
Fantastic.
I think maybe just the one thing to add to that is, apart from that, my biggest accomplishment is raising 2 daughters in New York City. We're kind of close to the end of that, but it's sometimes been easier to live through a 5% drawdown.
Well, congratulations on that, because I've got 5 years to go. My daughter just turned 13 and 11 days to the bat mitzvah.
Oh, that's fantastic. Tyson Halsey, introduce yourself.
Tyson Aly. I'm here in Charleston, South Carolina. I have an investment advisory firm called Income Growth Advisors. I've done quite a bit of work in the master limited partnership space, but these days I've shifted my focus to precious metals, precious metal mining. I do concur with much of what Jeff Hughes was talking about. I think that through my experience being 64, having been through the 87 crash, the 2000 peak, I think there's a lot to be said about cycles. I think the greatest book I ever read on investing is Irrational Exuberance by Robert Shiller. I read it about 6 times, and I think that it's very important to understand mass psychology and valuation. And so when we're at historic highs and everyone's talking AI, I'm skeptical. And that's why, I run money for individuals primarily. I have a hybrid SMA hedge fund strategy focused on gold mining and mining stocks. And that's where my attention is these days.
Fantastic. Thank you, Tyson. One piece of housekeeping I didn't do. This is going to be a conversation up front here among the panelists, but you are invited into the conversation. The only request we have is if you ask a question or make a comment, just keep it concise and to the point. If they need more detail, or they're not shy about asking. So with that, let's get it going. And Manoj, I'm going to throw this first one out towards you, which is really dealing with the Trump administration economic plan of tariffs, fair trade, energy, DOGE, tax cuts, interest rates reductions. It's going to create winners and losers. Where are you placing your chips?
Yeah, so I think like the prior speaker mentioned, valuations are pretty high. As far as sort of the Doge specifically, I think that trade in hindsight is almost done. It was sort of the short Booz Allen, long Palantir pair, sort of companies exposed to government revenues. But that's past. In terms of just sort of the uncertainty that is sort of ahead of us, just given sort of high valuations. And I think this has less to do with specific tariff impact or, specific things that the administration is doing. It's more sort of where markets are and where we've been. As a prior speaker pointed out, valuations seem pretty stretched. So in this sort of environment, and I'm going to sort of, give you a response that is specific to our fund and our strategy, which tends to be aggressive growth, but at the same time, a strong risk management and downside protection. I think sort of just given the environment, rather than moving to cash, because one of the things is if you wanted to sort of move to cash over the past 5 years, there's every 3 months, there's like this desire to do it. But I think this is the time to sort of put on some hedges to the portfolio, specifically around, you don't have to, if you're sort of fully invested or partly invested, maybe worth hedging 30 to 40% of the portfolio sort of with, 3-4% out of the money. S&P puts sort of given that the VIX is at about 15 right now. And what they say is, when you don't need to hedge is the time you should put on hedges. So I would say at this point, maybe start protecting the portfolio, not all of it, part of it, because it is expensive. You're giving up some yield to protect the portfolio. So maybe 3, 4, 5% out of the money S&P puts that expire in December, January. I think once we're past December, once sort of the Fed story is baked in, once the tariff story is baked in, then I think it's going to be a lot more clarity in 2026, which is the time to become super aggressive, and we can go into that as well.
Fantastic. Suzanne,
On this,
on this, yes. Sorry.
I was so
So
wrapped.
we're looking for winners and losers. Where are you placing your chips? And
So
current
yeah, so like Manoj, I mean, first of all, in the investing we do out of the family office, we don't do direct deals. We invest only in funds with the best managers that we think we can find. And we tend to be very heavily alternative focused. So by nature, we live hedged, right? We're not in long only either on fixed income or in the equity markets. I mean, I suppose there's the argument that private equity and venture are long only, which they are, but it's kind of a different animal from that perspective. So I think we're pretty conservatively positioned, but also being opportunistic. I totally agree with what the prior panelists said about healthcare. I think there's huge opportunities there in the public markets. They are overall undervalued. We actually also are invested with a biotech manager who's very good on the long and the short side, because while I do think overall I would be, net positive and net long healthcare, I do think there are going to be losers, and particularly because of the regulatory environment. I think that I agree with Manoj that valuations are stretched. I'm nervous about the market. I understand why the Fed is being pushed by the Trump administration to cut. I'm in the camp that they will likely cut 25 basis points. I frankly would like to see them not cut, because I think we need to have some pain to get some of this froth out of the market. We have spent too much time over the last decade plus kicking the can down the road. We had a conversation yesterday about a credit panel that I'm on, prepping for the credit panel that I'm on tomorrow, talking about if you look at public default rates, right, and things that you can actually look at, they're down. But you look in the private markets at what's actually going on, and default rates are starting to tick up. And so it's kind of the canary in the coal mine that people are not paying attention to. Another thing I'm worried about in terms of just structural dynamics in the market is this concept of retail having more access to alternative product. Mark Lazary was on CNBC about a week ago and being asked about this, and he said, what people really have to understand, and that the public at large doesn't understand, is that liquidity is not there when you invest in these assets, and the public doesn't really understand that because they're used to having daily liquidity in most of what they invest in, and 10 years really is 10 years, and maybe it's 12. And so that's concerning in terms of how market dynamics change, and it could take demand away from public markets, which will I think cause things to be softer. So long-winded answer to say we're pretty conservatively positioned. We're being opportunistic in things like biotech, healthcare, defense is obviously a very interesting area. AI is obviously one of the biggest, most exciting things, but I am of the belief, and Kevin Ryan, for example, would say differently, in the sense that these companies, unlike the NASDAQ bubble, the original one back in the 90s, most of those companies didn't have revenues. And, Kevin was the CEO of DoubleClick. I banked DoubleClick back in the day, and we took the company public, and then it cratered. And if you could have bought shares of DoubleClick probably at a $250, $300 million valuation, when the Justice Department was looking at splitting up Google, the valuation of that asset's now $100 billion. So Kevin would say the difference with AI is these companies actually have revenues. The companies like DoubleClick, back then it was all pie in the sky, but I do think there are going to be winners and losers in AI, and therefore there's going to be an opportunity there on the short side as well.
Great. Actually, you raised the point, and I know from our prep call for the next panel, Andy had spoken about this at some length on our prep call about getting the alternatives into retailers' hands and what large managers are doing. Andy, do you just want to throw in your comments since you raised it here? I guess I can get a mic here. See, you didn't know you were going to be on yet, and I caught you totally by surprise answering an email over there.
That's tomorrow. That's tomorrow's panel.
Mark, you don't want to give it, you want to give it away now. You want everybody to come back tomorrow, right? So no, but for them in terms of alpha, I'll just put it out there. I'm not going to, draw the conclusions. That was our discussion. So what is changing is the structure of alternatives in terms of how you can access them. Firms that were pure institutional are creating vehicles accessible to retail investors. But what I was saying was, although the name and the pretense of the retail strategy was there, the limitations of those structures meant that those managers couldn't do all the things that they were good at in a private structure. And you weren't necessarily getting, in this case, maybe alpha that you would get in the private structure. And you have to figure that out.
Well,
Some strategies are more amenable. Futures, for instance, others are really terrible, like credit.
well, and I would just add to that there are managers, for example, in private credit who have structures that are way more liquid than they should be. And that should be terrifying to people because it's just a disaster when the thing needs to be unwound.
Yeah, they're just too easy terms, right? Tyson, we're going to bring
You want to,
in
as you look at
Go on.
managers a little bit on the next panel, but as you look at managers, you really just want to understand the liquidity of the asset versus the liquidity of the structure. And there should be a match there. The large cap long short equity guy who wants a 2-year lock just because he can, if he's liquid, he shouldn't have that just because he can, in my opinion. I mean, I love Izzy Angler. I've known her since I was a child. I was invested with him for a long time. When he went to a 5-year lockup, I called him. I said, "This doesn't make sense." He said, "It doesn't. It makes sense for me and my business and for pension funds, but it didn't make sense." And so we redeemed.
Gotcha. Tyson?
I think the idea that private equity and venture capital, I'm not sure exactly what it is, being offered to the public at this stage is potentially a horror show. I think that, it feels like, okay, all the good money's been made there. I think that the return history has always understated the volatility because you can't really measure volatility the way you
don't have
can
to mark
in real markets. Excuse me?
You don't have to market.
Exactly. And consequently, they say, oh, look at our risk adjusted returns. They're so great, but I think it's completely fraudulent. And I think this is a great time for big institutions who are heavy into this business to bring in new money, particularly if we're going to get a recession and the market turns down, because the values on all of those things will be in trouble and they won't be able to attract any capital. So welcome retail.
Well, I want to take it back to the family office level because that's who we're talking to today. And I think it brings up an important conversation there too about managing illiquid versus liquid in the current environment. Where should you be and how should you be thinking about this? And Suzanne, if you don't mind, I'm going to kick off to you. We'll have you.
Yeah, I mean, I think that's a complicated question to answer. And I think for family offices and high net worth individuals in particular, it varies based on your needs, your asset base, your liquidity, your risk tolerance. I mean, there's a whole lot of answers that go into that. I mean, for example, the OCIO that we use in our family office, my 74-year-old stepmother has a very different portfolio than I do at my age with a 13-year-old daughter. She's got different risk tolerance, different needs, doesn't want to be locked up for as long as I might be willing to be locked up. So you have to think about it from across the board. And in terms of liquid assets or illiquid assets, I always believe that the only free lunch in the investment business is diversification, only if it's meaningful, right? Because some people say, oh, look, I own 10 different fund managers and they own 200 stocks apiece. I'm just making this up, but and I'm diversified. And then when you look under and the correlation of all the things that those 10 managers own, it's one. So meaningful diversification is very important. And you only get that by being invested across asset classes. So we're in everything from venture to very liquid, long, short equity and, the myriad in between.
I just want to make one comment.
Sure.
So many people will probably remember who Paul Allen was, Microsoft guy. But Paul Allen owned like 100, 200 private companies, right? And Nathan Troutman, who's been a member of our group for many years, he was winning a CIO and his job was to sell all those companies, right? Sean Sebastian, Birchmere Ventures out of Pittsburgh. You know, his job was to sell. His father owned 75 companies, his father-in-law, and he had to consolidate down to like 20 companies, right? And so those are like old stories. There's a lot of family office.
But it's going to be tough for Marty. Marty was saying that there's a lot of families that have portfolios of private companies that are going to need to become more liquid. And part of the issue with that is it's become harder, right? There's a huge backlog of companies in the venture space that want to go public. M&A activity has slowed. Maybe interest rates coming down again will help that. But small companies tend to, and this is where we operate at Lampen Conway, in the smaller, lower middle market, because these companies tend to be haves or have-nots, and they become have-nots a lot more quickly than bigger companies when things are not so good.
And the need is very evident, and they're willing to take on, some very coupons that are very large. Let's put it that way.
If they can get financing, I mean, part of the problem for small companies is money was free for so long that they over levered their balance sheets. And now with tariff pressures and economic pressures and business, cost of goods being up, et cetera, they're already levered. So to add more expensive leverage on other leverage for small companies in particular, it's very, very hard.
Yeah, well, it's the choice of, do I go bankrupt or do I try to leverage and survive another day and see how we do and try to wait it out till you're turning enough profit to pay those all down? It's a tough position for a lot of small companies.
Well, and we try to work with small companies to help them with those problems. I mean, unlike a lot of people in our business, we want to see the companies succeed. Whereas a lot of credit people are just like, well, if I, end up with the asset, I'll turn it and pull it apart and sell it. I mean, so we often give advice to these smaller companies, don't do a down and dirty equity round. Don't do straight debt. Maybe a convert makes more sense for you if it's structured the right way. So we really try to work with companies to help them solve those problems.
And how small of a company do you go work with?
Pretty small.
Pretty small? Okay.
Suzanne, I'm not sure how long this is going to last, but we're seeing more large private companies doing these bridge rounds, which to me is, I don't know, it's new. I mean, very large bridge runs.
Yep.
So
bridge loans are very popular right now. Just yep.
Yeah, that is again, that's larger companies. I'm talking about the have-nots that don't have access to things like bridge loans because nobody will give them to them unless it's so usurious it really doesn't make sense.
Hey, Tyson, I want to come out to you in South Carolina there and have you talk about because we were talking about liquidity and illiquidity for family offices. Let's talk about the 60-40 model and how that should be rotating or changing.
What I know about asset allocation is rudimentary, but it's based upon Markowitz mean variance optimization. And what that basically is you want to take a look at your expected returns in varied asset classes and factor in some cross correlations or covariances and optimize. And when I look at stocks where the 60-40, which was developed in the late 70s by some Nobel Prize winning guys like Markowitz and Sharp, back then, it made a hell of a lot of sense to have 60% in the S&P 500, and that's probably because it was trading at about a 6 PE or a 7 PE and had a 5% dividend yield, and bonds were yielding 15%. So 60% in stocks and 40% in bonds made a lot of sense. Today, it doesn't. It really doesn't make sense. So I say 25% cash, 25% commodities, 25% stocks, 25% bonds. And I would venture to say that I would want to get away from the S&P 500 and the triple Qs because those are so heavily invested and so correlated that if we do actually start to have a break, you're going to get hurt. but I think what you want to do is there's plenty of equity to be bought in the international markets and the emerging markets. There are a lot of good income vehicles other than bonds to own, so you can generate good yields. You can get the diversification that Suzanne Murphy was talking about, good diversification. And I think that 60-40 has the benefit of 40 years of doing great, but frankly, I don't think it makes sense going forward because it doesn't have real diversification benefits that people think because it was developed by some Nobel laureates when conditions were entirely different than today, makes sense. But people don't really understand who and why it was developed and how those models are derived. But I'm not as bearish as Jeff is, but I think that there is definite risk. And I've been through the bubbles. I remember 2000 quite well, and I just think that 60% in U.S. equities, large cap growth is a prescription for potential downside risk, and you should be looking elsewhere. I think particularly if you have a declining dollar, being in Europe, international as well as emerging markets makes sense. So,
And I would just add to that, Tyson, though, I think that, you mentioned there's individual stocks to buy versus buying the Qs. It really depends on how focused either the family office or the high net worth individual is on the markets every day. I'll tell a quick story. When I was a young woman just out of college working on Wall Street in a training program, my homework assignment for the weekend was to do a research report on a stock, and the stock was Northwest Airlines before the Chechis took it over. And I'm sitting by the pool at my parents' house on the weekend, and my dad was retired, and I said, and I didn't have any money, right? I just graduated from college. I said, Dad, you have to buy the stock. I said, I'm convinced it's getting taken over. And he said, I don't buy stocks. I said, what are you talking about? We're sitting in this house because you bought stocks. He said, the day I retired, I gave my money to smart guys who were sitting at a computer. He called it a Quotron because that's what it was back then. So it wasn't a Bloomberg or the things that we know today. And that are sitting at a Quotron and paying attention to this because I'm going to be on a ski slope or on a fishing stream and not paying attention, and something's going to happen. And lo and behold, many, many years later, she forgave him, luckily. And my stepmother had a small portfolio when they met. And because she wasn't that large, he had her in some individual stocks. And he was good friends with Ace Greenberg. And so he owned some Bear Stearns for her. She still owned it when it went bankrupt because he forgot. So if you're not paying attention, if it's not your day job, hire somebody whose it is or invest in the indexes, I think. And then I think when you're investing with people like Manoj, again, a conversation I had with my stepmother, because we're invested with some macro managers and they tend to be more volatile because one of the things Kevin McGovern talks about is catching the current, riding the wave, right? If you've ever surfed, you're sitting there waiting. And if you're not early, you're not going to catch, the current or catch the wave. And so that sometimes requires you to be patient through volatility.
Manoj, why don't you chime in with some strategies that you're looking at right now in response to the current markets, and also what, commenting on what Suzanne just said.
Yeah, absolutely. So, sometimes when you're at the desk, as Suzanne mentioned, at least on a trading desk, like you don't even leave for lunch or to get a cup of coffee because you may have events like, what happened in April. The tariffs were put in place, and then at some point they were reversed. And you saw this, 12% rally in about 4 days. And I think like 6% of that rally came in the 30 minutes of that Monday in April when they announced the delay in tariffs. So, obviously we're not sitting there reacting to take every move, but, you have to be around the desk to sort of protect your LP's capital and invest wisely, right? Based on what you've sold your fund as. To answer your question about the strategies that we're looking at right now. So I'm a little bit more optimistic than the first speaker in the sense that I would say never underestimate the US Fed, never underestimate the United States. What's happening right now is that you're going through a period of transition that will sort of get through, the tariff situation will be a lot more clear by the end of December. Coming out of that, the US Fed, if you sort of think beyond interest rates, there's a whole lot of other stuff going on. And, you have a Treasury Secretary that's, quite involved right now. is just beyond taking rates down 50, 100 basis points. It's about the stuff they can do with the balance sheet. If you kind of think of what happened after COVID, I mean, the kind of stuff that the US Fed did, let's not forget, I did a presentation for some students at a business school, and I called it the mother of all QEs, sort of akin to the mother of all bombs, right? The kind of stuff that they did, buying high yield, buying muni bonds, the LSAP program, after the great financial crisis, there's a ton of innovation, and I think it's very thoughtful innovation. Now, the whole question about deficits is a different, at some point it's going to end. But for now, I think the Fed is sort of getting geared to its next round of easing that's beyond just interest rates. And we can go to like flattening of the curve, the twist program, what they did with in order to get mortgage rates down to get the economy back up and running.
I think now's the time to discuss it. So,
Oh, okay. So if you sort of go back to 2010, 11, 12, you had rates go to zero, you had QE, the large scale asset program, TARP, stuff like that. In 2012, 2013, the economy was still having a hard time sort of kicking off, right? Because of bank regulation was coming in, and the banking system was, in a sense, not frozen, but slow. So they introduced this thing called Operation Twist, where basically you take the balance sheet, as you have your near-term maturities maturing, you take the maturities and invest in the long end. And if you sort of think about what's happened right now in the US, they've cut rates 100 basis points. Let's not forget, they cut 100 basis points last year, including a 50 basis points of price cut 6 weeks before last year's election, which is to me kind of a little surprising. But, we got 100 basis points last year, but mortgage rates never went down to 5, 6%. Mortgage rates still remain high. And that's in a sense frozen the housing market. Now you have sort of this new Fed or this new Treasury sort of come in 2026. If they engineer what, flattening of the curve, sort of getting the long end down in terms of just keeping the balance sheet steady, you don't need to expand the balance sheet. Take the near-term securities that are maturing, invest in the long-term, get the long end down. That has a direct effect on mortgage rates. And I think Besant had this op-ed in their journal over the weekend. I think they're targeting something beyond rates in the sense that if you get the mortgage rate, 30-year fixed rate mortgage, down to the 5% level, rightfully or wrongfully, that sort of kicks in this new round of discretionary spending, and the economy starts to kick back in without doing, with basic interest rate cuts, but also sort of being innovative on the balance sheet. I can go on, but
I know you've been shouting to get in a comment.
No,
Have
I
one
actually
next.
had a question for Manoj, sort of following on to what you were saying before we went to the interest rate discussion. But your focus is on North America, and do have a new dynamic that I wonder if you have an opinion on how it affects the market. Right, the U.S. government buying 10% of Intel.
yeah,
what do those kinds of actions on the government's part? How do you think that affects markets?
Yeah, so I think that specific stock, it did affect it, right? But I think the way it was structured was basically, I guess, the grants that were given through the Inflation Reduction Act, instead of the company getting it for free. Now you kind of get a non-voting stake in that company. I don't think it's going to be frequent. I mean, they had this idea, the sovereign wealth fund, which I thought was a good idea, but again, they scrapped that. I think I'm, as sort of a pure capitalist, it's something I don't want to see. But in exchange for a non-voting share of a grant that you were supposed to get, instead of giving a company free money, get something out of that. I mean, I don't think the deficit is going to change by just the U.S. government holding a share in Intel or even NVIDIA, right? It's just more sort of signaling that this is not free
I just
money
wondered if
anymore.
you felt like it could affect the market structurally in any way.
I think it's so few and far between that I think it's unlikely a structural change. I mean, the sovereign wealth fund could be a structural change, but I think the plans for that have gone away, right?
I have a question from the audience. The respectful of the U.S. positioning, what do you think are interesting international markets and opportunities?
Tyson, I'm going to toss that one to you. So the question is, international
This isn't that international, but I think Canada actually looks very interesting because of their being a safe place and tremendous natural resources. And I think that would be one area. I mean, I know that I like international in general and emerging markets. Certainly Argentina with Malay was doing well, but it looks like I'm not sure what's happening politically there. Right now, I'm suspect about that, but I think that Canada would be a very interesting place to put money that's non-US.
I think there's interesting places in lots of different parts of the world. And not to sound like a broken record, I'll go back to more so than in US markets and things we understand better when you're investing in emerging markets in particular and foreign markets, maybe to a lesser extent, you need an expert and preferably someone who's on the ground. Because when you talk about Argentina or Brazil or India or China, for example, the political situation is incredibly sensitive, can change on a dime, and you need people who have really the finger on their pulse of what's going on, from everything from a cultural perspective to a political perspective to an economic perspective. So I think that makes it much more complicated because in the United States, we're sort of lulled to sleep by the fact that we have this government that we might not like it or we might like it, but it works. Other countries, there are wholesale changes in very short periods of time that can really affect what's going on. I once was working with somebody who invested in the bonds of an oil rig off the coast of Brazil, and the bonds themselves were governed by Norwegian law. He said, so this is going to be fine. It's governed by Norwegian law. The Brazilians can't do anything. I said, I know a little bit about Brazil. I've spent a lot of time there. If the Brazilian government decides to change the day rate on this rig, they don't care that these bonds are governed under Norwegian law. And I said, and you're not Paul Singer and you can't go fight the government of Brazil. And sure enough, what I predicted happened. The bonds had huge problems because the government just woke up one day and said, too bad. Similarly, I think it's really important investing in Europe. Again, it feels much more familiar to us, but outside of the UK, the Nordic countries and Germany, rule of law is sketchy in a lot of places. You are involved in something that's in southern Italy and there's a family that owns the business that knows the judge. Judge doesn't care what the covenants say or anything like that. So I just think there are opportunities. I would definitely say in South America, again, to the point about Canada, rich in natural resources, a lot going on there. But again, the political situation is you have to be very careful about. So you really need to have people making those asset decisions who are very in tune.
I actually say largely agree with that. I mean, like within the US itself, there's 3,000 companies, there's all sort of alternative assets. There's enough and more time to spend here than deal with the currency risk. And for example,
and that's exactly the currency risk too.
Yeah, and sort of like even sort of watching the events of the past like 2 months, I'm so skeptical about this India, China, Russia bromance. I mean, they're natural sort of enemies sitting next to each other, right? So there's stuff that happens locally that you really have to be there to monetize it.
I guess that brings up the question, of de-dollarization, right? There's a trend towards that right now. There's the threat from China that we heard Jeffrey Buch speak about. And I guess my question is, do you see that impacting your strategies at all, Manoj, or do you think that creates some opportunity someplace that we're not looking?
I'm also to answer your question, I'm sort of skeptical about the de-dollarization. I mean, maybe in the last 6 months or the next 3-4 months, we might see some effects, but actually one of my top views is to sort of get back into a short euro position. It's just that, I mean, you look at yields across European countries are at all-time highs, Japan all-time highs, and arguably, actually, US sort of curve has flattened a bit over the last, I guess, couple of months versus some of the European economies. Europe is up, the Vanguard VGK ETF is up 25% year to date. I'm sort of in the process of establishing maybe a short position in that. I think it's come too far too soon. And at the end of the day, the de-dollarization, I mean, oil trading, corporate bond issuance, the dollar is actually, I mean, it may be a generation away. The one thing I would point to is, I wrote about this, and I do a monthly letter update for my LPs. You can just go to my website and sign up. But if you look at Steve Moran, the head of the CEA and the new nominee for the Fed board, he had this paper out last November, which I think got him the job in the administration, talking about how the strong dollar had negatively impacted the U.S. because as it sort of placed as a reserve currency, because the strength of the dollar, the U.S. manufacturing had sort of depleted, and that's sort of the traditional sort of view of the administration, right? Rightfully or wrongfully, that's the view. I think they would, I would argue, desire a weaker dollar so that sort of the U.S. export process kicks off again. It's just that, I'm not sure how many foreign reserve banks can place their assets in gold and silver, including other pension funds, like Norwegian pension fund. At some point you have to come back to the safe haven, and I think it's going to be the U.S. For at least a couple of decades.
Tyson, I know you have some thoughts along these lines. You want to chime in and talk about how it feeds into your gold strategy, and maybe you want to talk a little bit about specifically what your gold strategy is.
So I think that I've spent a lot of time looking at gold and gold mining, and I think that the two are correlated, but there's a very important lead lag relationship. And I think that actually one place for equity as an alternative to the S&P 500 is in gold miners and those stocks. And what I think is happening now is because the price of gold and silver has risen, suddenly this group, which has gone through a 14-year bear market, is coming out of a bear market. They are cheap, and they're doing they're beating estimates. Their valuations are very attractive, and I think that more and more money is going in. And just today, Anglo American bought Teck Resources in Canada, and so you're getting some consolidation in the mining. And I think that, as this cycle continues, I do think that the price of gold will go higher, but there is more money to be made in owning the stocks. And it's like, why own gold when you can own a good gold mine that's producing more and more gold each year? I think that the argument for good productive miners is far more compelling, and which is the essence of my investment strategy, is that you have a lead lag relationship. You look at the historic cycles, gold will go higher, but the stocks will move much further. And frankly, I think it's a pain in the ass trying to buy gold eagles or bricks or this or that. You can go buy these stocks. I think there's a lot of opportunity in some of the smaller ones. They're thin, they're tricky, but at least you can buy them and sell them. And again, I think Susan has said this repeatedly, and she's correct. In situations like this, having an expert help you in that those selections is critical, because just to remind everybody, because there's a great bit of fraudulent equity history, there was a company called Bre-X. And Bre-X, I think, had a couple $1 billion valuation in about 1998, 1999. And what some clever guy did is he took some old gold jewelry, he ground it up, he sprinkled it around, then they did, what they call grab samples. And they're like, look, there's gold. And they extrapolated it because somebody basically cheated. And it was a fraud. And there were some warning signs, but a lot of people got blown out there in a way that probably still gives a lot of gold investors headaches and why they don't want to touch mining. Go ahead,
Gotcha.
Suzanne. Looks
I've
like you're
gotta-
ready.
I got to stop you here because I only have a minute left, according to Marty. And I did want to get one more in for Suzanne, because we started this off. We said, that investing in special situations, restructurings is a potentially great area, but you have to know what you're doing. And I'd like you to talk to the family offices, what skills they need to have and things to really assess those opportunities.
So I think one thing to remember is we really haven't had distressed for a long time. As I touched on earlier, default rates look like they've gone down in public markets, where again, actually in the private markets and in private credit, we're really seeing an uptick. And that's probably because that's where the smaller companies live for the most part, and they have a harder time early on in a cycle. One of the things that we talked about for our credit panel tomorrow on the prep call was the fact that you're also seeing problems finally start to emerge in the private credit space. And a lot of the managers who have lent and written or underwritten these private credit deals have no ability to work them out, and no teams with that background. And when you have to roll up your sleeves and get your hands dirty and you need to have been in this business for a long time and know where the bodies are buried and know the restructuring attorneys and know the people that are involved that can help you. And there are a lot of minefields when you get involved. And, for example, we operate very heavily from the premise that we don't want to be on the creditors committee to the extent possible. We've done it. We know how to do it. We have the expertise to do it. But once you're on the creditors committee and you're under the covers, you can be in a roach motel. So we would rather, because you are now on the creditors committee and you discover the CFO committed fraud, you can't sell your bonds. So we prefer to have a big enough position in an issuer where we can have leverage over the process, work closely with management, advise management, help them access advisors to get restructurings done or right size their balance sheets without being on the committee. But we have the expertise to be on the committee if need be. A lot of the people who have underwritten a lot of what's outstanding today don't have that and are going to have real problems going forward. So we think that is going to be a really interesting area going forward.
Fantastic. Marty, is there a question from the audience that you had?
One of the questions here. So we're kind of brainstorming what our best ideas.
We need
We're going to get you a mic.
All
right.
Well, no, because
No, you can't hear them on the internet. And that's, half the audience.
There you go. That was great panel. Suzanne and everybody, thank you. As we talked about de-dollarization, the degrees of freedom, I think Manoj referenced, this creativity. I'm a little bit skeptical about the degrees of freedom we might have, right? We have been running deficit for a very, very long period of time. It might be unusual to see the RICs get together, but, it's a long discussion, but it's not as unusual. My question is very simple. It's, would there be a situation where the Fed's hand is forced and there are no cuts? If anything, there might need to be another Volcker. What circumstances would force something like that?
I'm happy to take that. Yeah. So there's absolutely a situation, right? If you do have the tariff pass through to goods prices, and let's sort of keep in mind that within the CPI basket, goods prices are 27% of the weight, and the rest is services and shelter. If houses prices keep going up and services prices stay stable to keep going up, and the tariffs sort of kick in next year, the costs pass through to tariffs kick in like Q4, Q1 next year, you're going to have inflation in sort of the core PC in the 3%, 4%, 5% range. In that situation, I think it becomes extremely hard to cut interest rates when inflation is so high. And if you have sort of a stable job market, I think that's when the Fed is kind of stuck. So that's absolutely a risk to keep an eye on.
And I would just say, I think inflation is getting underpaid attention to. It's not the word I wanted, but in the sense that, the data that we look at says, oh, it's not as bad as we thought, and therefore the Fed can cut rates. And the tariffs haven't really kicked in yet. So anecdotally, right, I mentioned my daughter's being bat mitzvahed in 11 days. Swag is a big thing at these bat mitzvahs. A lot of the swag comes from China, right? Because there's a lady on WhatsApp that makes fake, sports jerseys. And instead of having to pay $99, you can pay $19. And you order a bunch of jerseys and they come from China. They're more expensive than my friends who had their daughter's bat mitzvah 6 months ago. So we're seeing it there. I will also say I go to Trader Joe's every Sunday. It's my routine. Go to the gym, walk to Trader Joe's, do my weekly shop. I used to spend about $100. It's now $125 to $130, and I'm not buying anything different. It's 2 bunches of flowers in the ground, and it doesn't. I'm not feeling that in New York. We live in New York City, like it's a cab ride, but a lot of people are feeling that.
It is family office inflation is about 10 to 15% versus the rest of everybody else. So
Marty's saying family office inflation is 10 to 20%, 10 to 15% versus everybody else.
And the guy said,
Cost him $1 million to keep it up.
it cost me 10 to 15% to maintain it, and he sold it.
So, yeah, well, it's got a lot to do with it. I would just counter that, some of what the administration's trying to do, right? So they realize that the tariffs could cause some inflation. So they passed the big, beautiful bill, right? With things that are going to make it cheaper for people. So, and they also are trying to cut interest rates that should put money back into people's pockets. So this is some of the calculus going on by the Trump administration to try to alter at least cover some of that.
But I think, if you my ex-husband was more of an economist and a bank strategist, and he and I were speaking about this the other day. I think that there is this false sense that tariffs, that the big beautiful bill sort of balances it out, right? There are some large companies, Walmart, et cetera, that may pass less through to the consumer. Then there's the guy who owns the independent shoe store on the Upper East Side that has a factory in Italy that's been bringing his product in from Italy for the last 35 years. He's getting killed. So it's a balance. The bigger companies are going to be able to absorb it more. And I think and I don't think the big, beautiful bill is enough. And I think we haven't talked about it. Also rising healthcare costs.
No, I'm agreeing that there's going to be inflation on this, especially as reshoring and
Particularly with our aging population.
Right. Especially as reshoring strategies take time. They don't happen overnight. Well, give me just a second. I want to finish the point and continue the conversation here in a little bit. Which is what I've seen, and I saw this firsthand, is we were working with a food manufacturer, only works here in the United States, and they were being approached by foreign brands and to produce them here, which will create jobs here, which will create. So, that's some of what the calculus is, right? On all these different things. I don't know if this is going to work or not work. I'm just saying this is what they're trying to do and what they're trying to have happen. So I think there's a lot to this. I think it's very complicated. I think he's kind of bullish on thinking we're going to have the answer by December.
Well, and by the way, when you say that it's
come much later.
complicated, we were going back to the conversation yesterday with Kevin McGovern, who does business in 80 countries around the world. He's got a team of lawyers working with his different companies, trying to figure out what these tariffs all mean. It's not straightforward. It's not like you get a cheat sheet and it explains to you how this works. You kind of have to go dig deep to try to figure it out. And then you're not even sure you figured it out, what it really means for your business.
And you have to understand what they're trying to open up markets for. So, the whole negotiation with India, right? They're trying to open up sales of agriculture, right, to India, and soybeans in particular. A lot of farmers have a lot of that right now. So that's, this is what is being thought about. This is what's being done.
We're going to ask the very last question. Donna Bellins at
Please.
It's going to be very succinct.
Marty's on a roll today. He's being very strict.
We're on a tight agenda.
Get a microphone. Just project. And Suzanne will go.
I'll repeat it.
It's important
inflation not to look at things statically, but to look at dynamically. The consumers adjust. They'll buy domestic supply will increase so that, the expensive goods will be substituted by cheaper domestic goods. Just to put a dynamic in that. But the more important question to Manoj, you mentioned gold stocks. What do you think of royalty trusts of gold stocks?
I think that's to Tyson.
Tyson royalties.
Royalty trusts are pretty logical because basically they make small investments in multiple mine projects, and those tend to be considered some of the highest quality gold miners to own. So yes, I like those, and those make a lot of sense.
I want to thank our panel. This was a great discussion. Thoroughly enjoyed it. Suzanne, Manoj, Tyson, great job.
Thank you, Mark.